All right, welcome everyone. Today we're going to tackle a really big question, one that's on the mind of pretty much anyone in South Africa trying to build a solid financial future. We're moving beyond just saving money and really digging into how you can make your money work for you. Let's jump right in.
So, let's just kick things off with a question that might sound super simple, but honestly, the answer is everything. Think about your savings account for a second. You put money in, you see the balance creep up just a little bit, but is it actually making you wealthy? Or is it just kind of sitting there?
Okay, to really get to the bottom of that, we have to look at the numbers. Because, what feels like a safe bet, well, it can actually be a bit of a trap for our long-term goals. So take a look at this. This chart shows what happens after 11 years of consistent saving. You've put in just over R500,000, and you end up with almost R700,000. Now that looks like growth, right? But here's the kicker. Once you factor in inflation, your money has barely gained any real buying power. It's not a wealth-building machine. It's more like a wealth parking lot. Your money is safe, sure, but it's not growing.
Okay, so if that's the problem, what's the solution? I mean, there has to be a better way, right? Well, the good news is there is. There are some incredibly powerful tools out there designed specifically for this. Let's break down the essentials you absolutely need to know.
First up, you've got the vehicle you're going to use, the tax-free savings account, or TFSA. And honestly, you should think of this as your investment superpower. Why? It's simple, but it's huge. Every single rand of profit, every bit of growth, and all the interest you earn inside this account is completely 100% tax-free. This is a massive, massive advantage the government gives us to help build wealth.
All right, so you've got this amazing tax-free vehicle. What do you actually put inside it? Well, your first option is what we call a growth asset, like an ETF. And the easiest way to picture an ETF is just like a shopping basket. Instead of trying to pick one winning company, you buy the whole basket, and inside are small pieces of hundreds of top companies. It gives you instant diversification, and it's designed for long-term growth.
And then you've got your second option, which is an income asset, like a government bond. Now this one's even simpler. It's basically you lending your money to the government. That's it. In return for your loan, they promise to pay you back in full, plus they give you regular interest payments along the way. It's generally lower risk than an ETF, and it's all about providing a steady, predictable income stream.
Okay, so we've got the vehicle and we've got the fuel, the ETFs and the bonds. Now let's see what actually happens when we put these tools to work. Because the choice you make here, it's not a small one. It can literally be R1,000,000 difference. No exaggeration.
So here's the setup. It's exactly the same as our savings example from the start. We're putting in R46,000 every single year for 11 years. The total cash out of our pocket is identical, $506,000. The only thing we're changing is where that money goes.
And wow, does this chart tell a story? Just look at this. On the far left, there's our old friend, the bank savings account, ending at just under $700,000. Then, in the middle, the government bond does a bit better, getting to about R850,000. But then, look all the way to the right. The NASDAQ 100 ETF ends up at a staggering R1.7 million. It's not even close, is it?
Yeah, just let that sink in for a second. The difference between the best choice and the worst choice here, using the exact same money, is over R1,000,000. That's not just a little extra cash. That is life-changing money right there.
So you're probably asking, how is that even possible? What's the magic trick? Well, it all comes down to one word: compounding. This is the real engine of all wealth creation. It's that amazing point where your investment returns start earning their own returns. It creates this snowball effect that starts small but over time becomes an absolutely unstoppable force. That's how the ETF pulled so far ahead. Now, I know seeing those numbers can be super exciting, but it can also feel a little intimidating, right? Like, where do I even begin? So, let's get practical. How do you actually get started with all this?
When it comes to actually putting your money to work, you've basically got two main strategies. On one hand, you can invest a lump sum. Just put all your available cash in at once. The stats show this often wins over the long run because your money just has more time to grow. On the other hand, you can do something called dollar cost averaging, which is just investing a smaller fixed amount regularly, say every month. This smooths out the market's ups and downs, and for a lot of people is just way easier emotionally.
Okay, so let's talk about how you might mix those assets we mentioned earlier, the growth-focused ETFs and the income-generating bonds. Here's a simple blueprint just to get you thinking.
The great thing is you can tailor your portfolio to your own personal comfort level with risk. There's no one-size-fits-all here. A beginner, for example, might want to start with a much safer mix, maybe 60% in bonds for stability and 40% in ETFs for growth. A moderate investor might flip that around. And then you've got an aggressive investor who might go almost all in on ETFs, aiming for maximum growth over a long time. There's no single right answer, just what's right for you and your goals.
And you know what? No matter which portfolio you end up choosing, your success is really going to boil down to these core principles. First, be consistent. Just keep adding to your investments regularly. Second, be disciplined enough to stick with your plan, even when the news looks scary. And finally, remember that your most powerful tool isn't some secret stock tip. It's time. It's not about timing the market. It's about time in the market.
So what's the big takeaway from all of this? Look, the numbers are crystal clear. The tools we talked about are available to you right now. And while it's so easy to sit there and wish you'd started yesterday or last year, the single most important decision you can possibly make is to start today. The question really isn't if you should be investing anymore, it's just when are you going to begin?